Here's something that surprises almost everyone. You can't actually buy a Costco franchise. There isn't one. No franchise fee, no application, no territory rights. Costco has never franchised a single location, and it never plans to. So when we talk about owning a Costco, we're really talking about something much bigger. What it actually takes to build and run a warehouse club business at that scale. Because the model itself is genuinely one of the strangest in all of retail. Most people assume a warehouse retailer like this makes its money the same way any other big box store does. Buy products cheap, mark them up, sell a lot of volume. That's almost backwards. The real engine of this business isn't the bulk size cereal or the discounted electronics at all. It's a small annual card fee that most customers barely think about. And understanding exactly why that fee matters more than almost anything else on the shelves separates the operators who could actually build a business like this from the ones who'd get the entire model wrong from day one. So let's actually open the books on this one.
The reality check. From the outside, a warehouse club looks like a simple bulk retail store. Massive aisles, pallets instead of shelves, giant packages of everything, a food court, and long lines at checkout. It looks like a straightforward volume business. Sell more, make more. What's actually happening is closer to running a membership club that happens to sell groceries, not a grocery store that happens to charge a fee. The merchandise itself is famously sold at razor-thin markups, often capped well below what a typical supermarket charges, which means the store essentially breaks even or generates only modest profit on the actual products it sells. The real profit engine is the recurring membership fee paid by tens of millions of cardholders every single year, largely regardless of how much they actually spend in the store. Add in a business model built around enormous bulk purchasing power, relatively few employees per location compared to typical retail footprints, and real estate strategy built around owning rather than leasing a large share of its warehouses, and you start to see why this looks nothing like a normal retail business once you get past the surface. That's exactly why building a business like this rewards operators who think like a subscription company first and a retailer second. The membership fee is the actual product, and everything on the shelves exists largely to keep people renewing it. But here's what the numbers actually look like.
Chapter 1. Startup Costs. Building a warehouse club chain from scratch is one of the most capital-intensive retail concepts you can attempt, precisely because the entire model depends on scale. That's difficult to reach with just one or two locations. A single warehouse format store, typically 130,000 to 150,000 square feet, requires either purchasing land and constructing a building or securing a large format lease. And construction costs for a store this size commonly run $20 million to $40 million, depending on region and land costs, with prime real estate markets in major US, Canadian, or UK metro areas pushing that higher still. Initial inventory for a store this size represents a massive additional investment, often tens of millions of dollars, since the entire model depends on buying in bulk directly from manufacturers to secure the low unit costs that make the membership fee worth paying in the first place. Equipment costs, industrial refrigeration and freezer systems for the grocery sections, forklifts and pallet handling equipment, point of sale and membership verification systems, and often an in-house bakery, pharmacy, and food court build-out can add several $1 million more per location. Licensing and regulatory requirements vary significantly by jurisdiction, covering everything from food safety permits for the grocery and prepared food sections to pharmacy licensing where applicable.
And a chain-wide rollout requires building relationships with hundreds of suppliers capable of delivering bulk format products consistently across every location. Here's what most people miss. Because this business model depends so heavily on buying power, a single warehouse location in isolation is genuinely difficult to run profitably at these thin merchandise margins.
The entire economics only really work once you've built enough locations to negotiate serious volume discounts from suppliers, which is exactly why this is fundamentally a scale business from day one, not something you ease into gradually the way a single restaurant or retail shop might.
Chapter 2: Revenue Streams. A warehouse club generates revenue through a genuinely unusual mix, and the balance between these categories is the whole story of the business model. Merchandise sales are the largest revenue number by far, covering everything from groceries and household goods to electronics, tires, and even travel packages. And a single high-performing warehouse location can generate well over $200 million in annual merchandise sales. But here's the number that surprises most people, and even lower for private label items. The profit margin on that enormous merchandise revenue number is genuinely thin, sometimes barely enough to cover the operating costs of running the store itself. Membership fees are the real profit engine of the entire business, and this is the part that separates the model from any typical retailer. Millions of members paying an annual fee, commonly split between a standard tier and a premium tier that offers a rewards cashback structure, generates billions of dollars in high-margin, recurring revenue with very little associated cost beyond the membership program itself. Renewal rates in this business are famously strong, commonly cited in industry reporting as being in the 90% range across mature markets, which creates a remarkably predictable and stable revenue base year over year. Ancillary revenue streams, in-store fuel stations, food courts, optical and pharmacy services, and travel and insurance partnerships add further high-traffic, incremental revenue that also serves a second purpose, keeping members coming back often enough that renewing the membership feels like an obvious decision rather than an optional expense. Here's what most people never think about. Because membership fees carry almost no cost of goods sold, that revenue line can represent the majority of the company's total operating profit, even though it's a small fraction of total revenue, which is exactly why protecting membership renewal rates matters more to this business than almost any single merchandise category.
Chapter 3: Operating Costs. Now, to what actually eats into that merchandise revenue? And this is where the thin margin philosophy of the model becomes clear. Cost of goods sold is enormous given the sheer volume of merchandise moved through each location. And because markups are capped so low, even modest supplier price increases can meaningfully compress margins across the entire chain, unless offset by even greater buying power as the company scales. Labor is a substantial cost, though this business has built a genuine competitive reputation around paying above typical retail industry wages and offering stronger benefits than most large retailers, a strategy the company has credited with lower staff turnover and stronger customer service despite running with fewer staff per square foot than a typical grocery store. Real estate and facility costs, whether owned outright or leased, plus utilities for running industrial-scale refrigeration and lighting across a massive footprint, represent another major fixed cost category that scales with the size of the store network rather than with any single-day sales. Supply chain and distribution costs are significant too, since the entire bulk purchasing model depends on an efficient logistics network capable of moving pallet-sized quantities from manufacturers directly to warehouse floors with minimal handling, cutting out much of the cost structure a typical multi-step retail supply chain would carry. Here's the retention hook worth remembering. Because merchandise margins are deliberately kept so thin, this business has almost no room to absorb inefficiency anywhere else in the cost structure, which is exactly why operational discipline in logistics and real estate matters so much more here than in a typical retailer that can rely on healthier product markups to cushion mistakes elsewhere.
Chapter 4: Profit Margins and Real Numbers.
So what's actually left over? This business is famous in retail circles for extraordinarily thin overall net margins, commonly cited in industry analysis as sitting in the low single digits, often around 2% to 3% of total revenue, which sounds unremarkable until you realize where that profit is actually coming from. Let's run a simplified example for a single warehouse location. Take a store generating $250 million in annual merchandise sales, with merchandise operating margin, after cost of goods and location-level operating costs, running at a thin 1.5%, or roughly $3.75 million. Add in membership fee revenue allocated to that location, say $8 million, from a member base of roughly 90,000 households paying an average membership fee. And because that revenue carries minimal direct cost, treat the bulk of it, roughly $7 million, as pure operating profit. Combine those two figures, and that single location generates roughly $10.75 million in total operating profit. And here's what makes the model so unusual. Membership fees, despite being a tiny sliver of total revenue compared to merchandise sales, contribute nearly twice as much to actual profit as the entire merchandise operation. This is exactly why the business obsesses over membership growth and renewal rates far more than it obsesses over merchandise pricing. Since a single percentage point improvement in renewal rate across millions of members moves the profit needle more than almost any merchandise category could.
Chapter 5. Risks and what makes someone succeed or fail. Now, the honest part. This business model carries real structural risks, and they're worth naming clearly. Membership saturation and renewal risk is the single biggest long-term threat because so much of total profit depends on that recurring fee. Any sustained decline in renewal rates or new member growth hits the bottom line far harder than a typical retailer would feel from a soft sales quarter, since the merchandise side alone generates so little margin cushion. Thin merchandise margins mean this business has genuinely limited room for error on cost control. A supply chain disruption or a period of high inflation on goods can compress already slim margins quickly if buying power and logistics efficiency don't keep pace. Real estate and expansion risk is significant too, since each new location requires enormous upfront capital and takes time to reach the member density needed to be genuinely profitable, meaning aggressive expansion without careful site selection can tie up serious capital in underperforming locations for years. But here's what actually separates a business like this that thrives from one that struggles: relentless focus on member value and buying power at scale. The companies that succeed in this model treat every merchandise decision through the lens of, does this make membership worth renewing? Continuously reinvest savings from bulk purchasing back into lower prices rather than higher margins, and expand into new locations methodically enough that each one reaches a genuinely sustainable member base before the next one opens. The operators who'd struggle trying to replicate this model usually make one of two mistakes. They treat merchandise margin as the primary profit driver and price too aggressively for short-term gain, undermining the long-term member trust the whole system depends on. Or they expand into new markets faster than they can build the member density needed to make each location's economics actually work. This is a business built for operators who think in decades of membership relationships, not people chasing a strong quarter of merchandise sales.
Everything here is general business education, not financial, legal, or investment advice. And it's worth repeating plainly that this specific company does not offer franchises. So this breakdown reflects the economics of the warehouse club business model at a corporate level, not an ownership opportunity available to individual buyers. What's clear from the numbers is that a business like this isn't really a retailer that happens to charge a membership fee. It's a membership business that happens to sell groceries. And the winners in this model are the ones who protect that recurring relationship as seriously as they protect their buying power. So here's my question for you. Would you rather build a business around thin margins and massive volume like this warehouse model, or a business with fewer customers but a much higher margin per sale? Tell me which you choose and why in the comments.